Welcome in Rajat Rajgarhia, CEO Institutional Equities at Motilal Oswal. Rajat, good to have you with us. I was just going through some notes, Rajat, and the kind of a view you're taking on the markets currently. It's interesting because you're actually seeing a shift from consumption to capex-led stocks. Talk us through, the strategy there, what you think would be a good way to go about investing at a time like this in these sectors.
Yeah, hi. Well, I think if you see through our recent reports that we have done, there has been reasonable noises that we have started seeing around the industrial or the investment cycle. Well, a lot of these are still very early evidence right now, but I think at least in the coming quarters, that is one trade that investors will be very keenly looking for. Last 5 years have truly belonged to the consumption cycle. It will be important to see if we can gather more data points and evidence whether the investment cycle is about to take off within the system over the coming quarters. Okay.
You've also talked about perhaps still staying away from autos for a bit. That's interesting because interesting to talk about that, Rajat, because this morning as well we've had so many reports coming in talking about this resurgence of interest in auto perhaps at these beaten down levels. Are you watchful till you see what happens post monsoons, or would you actually say that auto could be a good buy but just a little while from now?
Well, I think this is a sector which suddenly over the last 2 quarters have got into many triggers leading to a slowdown. And while what would have started with the whole NBFC liquidity crisis, I think the competitive pressures within the segments of the auto is also not letting companies earn any reasonable profitable margins when there is a period of slowdown. I would think monsoons looks like the first trigger that one needs to evaluate. Till then, this quarter, which is April, May, June, also should be a quarter of very moderate volume growth for this space. So from a portfolio allocation point of view, this is one space which after long looks like being an underweight or at best neutral.
Right. Rajat, what about the rest of the market though? Would you say that the best is in the price? Because it seems like, even as we've just concluded the first phase of elections yesterday, the market has already made up its mind somewhere on who the next PM is going to be. And if that were to be the case, do you think it will be a more muted reaction because the market has already moved up pre the event?
At 10,500, if the market would have entered into this election period, it would have been an easy trade for people where the downside was limited and the upside could have been big. So very smartly the markets over the last few weeks have moved up by 1,000 points to make sure that as we come closer to this event, the odds are fairly evenly balanced. But yes, given the levels that we are in the very near term, the reaction to a disappointment is going to be higher than the reaction to a positive outcome. But I just also wanted to highlight any election outcome is still good 40-45 days away, and there are many other triggers which keep driving the markets in the very short term, whether be it oil prices, global liquidity, or this whole earning cycle which is beginning from today with the frontline IT companies.
And I was going to come to that exactly. What then, Rajat, are you expecting from the frontline IT majors to deliver? While it seems like they are going to deliver as per expected lines, there will be no huge major disappointment if, the guidance was anything to go by previously. But, really, it's about what do these stocks can do further from what they've already done in the entire year gone by. I mean, is the best already in the price is the key question, I guess, all investors in TCS and Infi got to ask themselves.
Well, I think from a longer time point of view, the growth rate for the sector definitely has moderated. we have now got aligned well to a growth rate of about 8 to 10% on the dollar revenue front, and in between you have currency which comes and plays a very important part. In a year, whenever INR depreciates by 10-12%, you see IT sector which gets re-rated, which happened in calendar 2018. But I think one of the very important fundamental points also which has positively impacted this sector is that company after company has been doing buyback, raising their payouts, and that provides a huge support to the floor of these stock prices. And especially, like for example, if you are seeing company like INFOSYS doing a market buyback every day, they are themselves absorbing fair bit of supply into the market or from the market, right? So in an environment where numbers are still okay, rest of the corporate earnings cycle still have a more expectation build up of a growth, the underlying trend is still muted, and these companies are doling out big cash in form of buybacks and dividends. I would think they probably would remain where they are right now, because the growth rates are not very exciting, but there is some multiple adjustment happening because of better cash utilization of the balance sheet.
When we were chatting earlier, you said that there is also now opportunity for some beaten down names or some names that haven't really participated to now see a potential up move, names that have lagged. You gave the example of how Reliance Industries was the sleeping giant for fairly long, and then, now we're seeing some sort of a pickup. Where is that next opportunity that you're seeing? Are you seeing it in the cement space? Are you seeing it in individual other beaten down names?
Well, I think at all points of time, investors keep assessing that what could be the contra trades, what could be the trades that have not performed for a long period of time, and if you see an earnings recovery happening, then those stocks could be big return stocks. We saw that Reliance has been a classic case. In the last 2 years, it's been a phenomenal performer after a long period of no performance, virtually no performance. I think that is where at least allocation money tries to find a way to create alpha. At this point of time, we keep evaluating at what point of time telecom led by Bharti could stage up a normalization of their earnings and the multiples also. Cement is something which at least is looking like that after a long period of sluggishness in the earnings, you may see outlook turning for good. And as I mentioned, industrials versus consumption has been one theme which is very keenly debated. Last 7-8 years belonged to consumption in all forms. I'm not saying that consumption will slow down, but I think industrial needs to recover from here for it to make a comeback, and that could be one emerging contra theme of this market over the coming years.
Okay, so lots of different themes that we're looking at there with Rajat. Let's just also talk about I guess the favorite right now, which banks, NBFCs, corporate banks. Rajat, I think more than the question of whether or not it's an investment opportunity is really how much more of an upside, anything specific there that you're looking at in terms of positive returns, and in the near term, what's the kind of potential return you're foreseeing on some of these names?
Well, I think in the banking space, while this is now a consensus positive trade across portfolios, I think this is probably one of the best periods that you are seeing in Indian banking, where you have credit growth picking up, pricing power being reasonably good because competition from all alternate forms of financing or deposit mobilization is slowing down, and the credit cost recovery is there, which we can see every quarter in the bank's P&L account. Very important to figure out on which are the banks which, besides just recovering their credit cost, are also going to participate in this upcoming growth cycle. I think in that space, banks which are fairly capitalized, likes of Axis and ICICI, are definitely ahead in this race. And we have also seen many in the last 3, 4, 5 years, many new investment options in the banking also which has come up. RBL, Ratnakar Bank, which has been growing consistently at 35 to 40%, has also seen meaningful re-rating in this period, and we think their earnings outlook continue to remain very strong. And in between all this, I I think as and when you start seeing industrial activity picking up, the banks which are well entrenched into that are going to benefit even more. So this probably is going to be a period where banks' earnings will keep growing well, and even if you look at the topmost stock like HDFC Bank, you can still argue that 20-25% earnings growth will get well captured into the stock return. It is no more. It is not any expensive stock. The valuation still ranges closer to 20 times earnings, which is reasonably okay for a franchisee like this. So I think you have stocks across the spectrum in banking, right from the consistent return ones of HDFC Bank to the re-rating candidates which are already in the process like ICICI Axis and the upcoming guys like RBL Bank.
All right, Rajat, let you go on that note. Thanks much for telling us your outlook on the equity markets as well as identifying your top bets.